The market reaction, Barry Knapp, managing partner and director of research at Ironsides Macroeconomics, and Gabriela Santos, global market strategist at JP Morgan Asset Management. Referenced some of your thoughts earlier, Gabriela. You think, what do you think happens next week? They do or don't? They're not going 50. They do 25. The Europeans still did 50, but only to get to 3.
Exactly. I think they're further behind in the tightening process. So to them, there was still, for the ECB, there was still some urgency to get there while they still feel like they can. And they apparently, ECB also didn't want to signal any further issues by not raising 50 basis points. But the Fed is already in a very different situation, having already raised rates to that average of 4.6%. We do hope that they take the meeting next week to pause, to let the dust settle, especially given all of the tightening they've already done, and now all of the additional tightening that's going to happen in the economy through lower availability of credit and at higher spreads.
Net for stock investors. If the Fed is done, is that become a net positive, or does an even weaker than expected or more risk to the overall economy because of this? Does that offset the relief of we're probably getting the pivot, or we could get the pivot? They could stop. They could even cut by the end of this year.
So I think on average, it can take anywhere from 7 months to 15 months from the last hike to the first cut. It will very much depend on how much the economy slows and perhaps even contracts from here until the end of the year. But it is possible we can start to see rate cuts by the end of the year. I think the number one thing for us is that the peak in bond yields are in. And the number one thing we would be doing.
We're not going to 6%. The Fed's not going to 6.5, 7. Not in the cards.
I don't think it's necessary anymore to use interest rates as your only policy when you have credit tightening.
Well, then inflation could stay out of the bag then.
But can I just ask a separate question? Because we're talking about this all, I think, in a vacuum from the news of this morning or the news of the last 24 hours, which is, do you actually believe that the regional banking system in America is safe and finished? Do we actually think that this was somehow, First Republic was somehow like the last domino, and that now we've held up the last domino and everything is just fine?
No,
right? Okay, I don't think so either. In which case, I think there's a whole sort of, there's a lot more dominoes to go.
As we were talking about just before we started, there was a paper that came out. It's an NBER paper that went through the banking system and determined that SIVB was only the 501st worse off in terms of percentage losses on their securities portfolio.
Silicon Valley Bank.
Silicon Valley Bank, excuse me. And that if half of deposits left through the whole system, there would be 1,600 banks with negative equity. So, no, it's clearly a much bigger problem than that. And so the Fed has already declared the situation systemic. This idea of separating macroprudential and monetary policy is okay as long as you're not in a crisis. But we're clearly in a crisis. And so were they to take that risk and continue forward, it would be a monster, potentially a monster.
You're saying they're not going to raise next week?
I don't think they can. I think even if they try, they would, first of all, that summary of economic projections forecast has got to be, can't be for higher rates. That's what set things off in September and caused the yen, pound, and mortgage market to crash. So they've got to be careful about their forecasts and the press conference. So I think it would be a monstrous mistake to tighten.
So will the slowing economy take care of inflation? Or, if the Fed can't, they thought they had to go much higher for much longer. We kept hearing about it. If they don't do that, then are they Arthur Burns? Do they not? Do they allow inflation to stay? The dagger's not in the heart yet.
We do not think they would allow inflation to stay sticky at a 3-4% range. We do think it could just be a pause should inflation not seem to be coming down towards the 2% target in 2024. With that said, we do think it will because the economy was resilient, but it wasn't strong before this. There was already tightening happening in areas of the economy. Long and variable lags meant that other areas of the economy would be slowing down, and now we're just speeding this up with the tightening of financial conditions. So we do think the peak in yields are in, and buying bonds now is the #1 thing we would be doing.